What are the differences between an S and C corporation? How hard are a C corporation's taxes to do?
So an S corporation is a pass-through entity. It's all going to come through onto your 1040. So you do a return for it, 1120S, but all that's going to flow through to the shareholders, I should say, which assuming it's you, it's going to be your 1040. That's one difference. A C Corp does its own return, just an 1120, not an 1120S. It's a separate taxpayer. It gets taxed at 21%. It doesn't have anything to do with your 1040. It's in its own different world. The S corporation is going to have the ability to do your corporate, your 280A meetings, reimbursements that we talked about earlier for maybe an administrative office, things like that. You do have to pay yourself if you make enough. If you want to take the money out of the S corporation, you will have to pay yourself a wage, a W-2 wage. We call it a reasonable wage. It won't be everything. You'll have two streams of income in an S corp. That reasonable wage, which the IRS hits with every tax that they can throw at you. It's going to be income tax and employment taxes, but you'll have this other stream that's just a distribution. It's going to get hit with income tax, but it's not going to be subject to that employment tax. And in the given right situation, that can be quite beneficial. That's what we like about the S Corp. Now, the C Corp, it can still do the 288 corporate meetings. It still has the reimbursements in the office, et cetera, but it also has that medical reimbursement plan that we talked about way back earlier. But again, it does file its own return. And if we ever want to get money out of there outside of reimbursements, you're going to have to pay yourself a wage, or you have to do a dividend, which we call double taxation.
Yeah, so the biggest tax differences between an S and a C then in a synopsis is the S corporation doesn't pay taxes, it passes it to its owners. The C corporation pays a flat 21%. And then if those monies are paid out in the form of a dividend, they're taxed as long-term capital gains to the recipient, assuming that recipient is an individual or taxed on a 1040. And then how hard are the corporations, C corporations taxes to do? If you have a balance sheet, they're fairly simple. It's actually pretty easy.
That's a very good point. Yeah, you got to have good books.
And the big difference besides the 21% is a C corporation, you get to have a health reimbursement plan that is not taxable to the recipient, to the employee. Whereas in an S corporation, any benefit, even paying for insurance, is taxable to the recipient, who is a employee. So whenever you're looking at this, if you have a lot of medical expenses, or if you have a dependent who has a lot of medical expenses, so you're taking care of a parent, or you have a child who has high medical expenses, or you or your spouse have high medical expenses. When I say high, I mean over $10,000 a year, where it's going to start to move that needle to be able to write that off, and make it non-taxable to be able to reimburse that. A C corporation really becomes something that could benefit you. And I've seen people who deliberately structure their affairs in such a way that the C corporation is a managing entity to cover those expenses because they're $40,000, $50,000 a year. And they want to make sure that they're not dealing with Schedule A phase outs, missing out on things, and not getting to write those things off. And that is a huge difference with the C Corp. Just to put it bluntly, that can make a pretty massive difference.
Yep.
And we have clients that do that. There's nothing wrong. There's certain types of activities, like if you're a realtor, if you're doing construction, sometimes escrow agents, where they have restrictions on the type of business you could be. Sometimes they want you to be an S, sometimes they want you to be a C. It's always up to the licensing. But other than that, most businesses can pick and choose, and then that just becomes another number. It's like, hey, should I do this? Well, here's the good, here's the bad, here's the ugly. What's really interesting is when you have high net worth, high income people, and they don't need the money that C Corp's making. And the money, if it had flowed to them, would be taxed at 37% plus their state tax. It's kind of neat when you see that C Corp being used. And then people always say, well, but it's going to have to be paid out as a dividend. No, it's not. Most C Corps zero out. If they're accumulating income, they're not required to pay it out. There used to be like the retained earnings tax actually meant something. Now it's pretty immaterial. And as long as you have a reason to use that money, you could be loaning it to yourself for all that matters, or to other entities and replacing the bank. As long as you are documenting why, it's not uncommon. Like we look at, what is it, Apple sitting on $200 billion. Yeah, it's like you're allowed to have stockpiles of cash as long as there's a reason for it. You're not always taxed on it.
Hey guys, if you like this snippet of Tax Tuesday, then I invite you to click the link and actually subscribe to become a Tax Tuesday member. Every other week we do these live, and you too can ask your questions, and myself and my team will answer your questions on the next Tax Tuesday.